We begin tonight with a look at the state of the global economy and an outlook that has dimmed recently because of tightening credit conditions. Investors, of course, also having to consider the possibility of the U.S. potentially going off a financial cliff. Here to help us make sense of it all, Brad Simpson, Chief Wealth Strategist at TD Wealth. Brad, always great to have you in the program.
Oh, great to be here.
All right, some big themes here we got to plow through. Let's start with inflation. Where are we in the fight?
Well, I mean, despite what we saw yesterday, where inflation in Canada was 0.1 of a percentage point higher than what expectations were, that all in all, we're making good progress there, and I think that's incredibly important too. It's one of those things that, we keep talking about it, we keep going over and over with it, but at the end of the day, the number one thing that for the long-term good of financial markets is that inflation needs to get under control, and that we're getting there. And if you want kind of proof to that, the one who's been combating it and is charged with getting it under control are central banks. And so we recently saw, of course, the United States, where after 500 to 525 basis points of increases, unexpectedly, the U.S. Federal Reserve Board came out and said, our last 25 basis points, that's probably it for now, and we're going to take a wait and see from here. In the U.K., not quite as clear as on that, but you start looking and reading what the Bank of England is saying, and you're seeing it getting closer and closer kind of to the end of the rate increases there. Europe, kind of a different story, still a ways to go, but instead of 50 basis points every time we're raising rates, we're probably closer to a 25. And I think that all of that is a sign that, it's not yet to the target where you want to be. And I think you got to use some caution when it comes to this. This is not going to be a straight line,
exactly.
Right? And I think sometimes in the world we live today, we think we take action, there's immediate reaction. They're going to have some ups and downs along the way, but we seem to be on target where we could be reasonably talking about that into that 2 to 3% zone a year out from here, and that's really where central banks would be a lot more comfortable, and the trend is definitely on its way there.
We've been warned to get to that place. It's going to mean some pain. It's going to mean an economic slowdown by the very nature of what they're doing. So what is the state of the economy right now?
The bottom line is the economy is still very good. And when we look at the leading indicators, we can see the things like where your manufacturing is starting to slow, and you can kind of see that start to happen around the globe. The most important thing that we've been looking at are the leading ones, because those are the lagging ones, the ones that's going to take some time for us to be able to get there. And so what we've been talking an awful lot about is this story in many ways comes down to two things: employment, labor, and the consumer, and they kind of go hand in hand with one another. So if you look at today, the unemployment rate in the U.S. is 3.5%. I mean that is the lowest it's been since 1969, which was 3.39%. And so if you're kind of doing math at home, I was born in 1969, so you can look at the screen and you can decide how long ago that was, but it was quite some time ago. But we do see that starting to change, and you're starting to see, if you look at small and medium-sized businesses and surveys there, they're starting to change their hiring plans. When we look at the use of temporary workers, all of a sudden we're seeing less and less temporary workers. Temporary workers are always the first sign when you stop using those, is that you're going to end up starting and looking at the rest of your workforce as well. So when we look at that, we go, we start to see across both in Canada and the United States that we think that the labor market is going to start to weaken. So if that starts to happen, of course, it takes you over to the consumer.
Yeah,
and
slows down.
Yeah, and so I think you got to look at it in those terms, is to say, yes, you have inflation. Yes, it's painful. I'm not happy about paying money at the store, but I got a good job. Yeah. Well, if that starts to come under pressure and you start to worry about that, and we can already see when we look at the consumer that their balance sheet is not as clean as it was a year ago. We can look down at the U.S. and say, like, your accumulated savings was $1.5 to $2 trillion. We think it's roughly down to about $500 billion now. Now, that's a big move, and so if you look at the rate of that spend, and then if you dig into that rate of that spend, and you can actually see the folks who have that biggest amount of capital laying around is kind of the high end of people who have more share of wallet or more wealth, and they're less inclined really to go out and be actively spending. All of that starts to point to a slowdown for the consumer down the road. While healthy now, that because this is a lagging indicator, we can start to look 6 months out or so and start to see that start to change. So the global economy, I think the last story would really be the strength of China in that. China is having rather a lackluster opening as well. And so we think that the economy, as designed, is going to start slowing.
What does an investor do in terms of putting that to work in their portfolio?
Yeah, well, I think the starting point is that one of the things that seemingly have been then lost around is I think a good starting point is remembering this is about investment, and it seems to me that every year that seems to go by, that things speed up, and that gets lost along the way. So when I say it means about investment, is ultimately you're allocating capital to something that you think is going to have more value down the road, but as part of that passageway is that things are going to happen along the way. So I think the second part then is that we're going to think about what you're investing for. So thinking about what those time horizons are clearly. And then the next part is how am I going to allocate capital? So right now we are overweight fixed income. And, if you think about the first half of the show, what are we talking about? Rising interest rates to slow things down. If then the opposite is that, once you slow things down, you bring interest rates back down again to get things going again. Typically, that is really good for fixed income markets. So today, 10-year Treasury at 3.5%, and you kind of look across, the capital stack from there, that we think that fixed income makes an awful lot of sense. We actually published today a kind of a special edition income piece that we call Forest and the Trees. And it's really where we're talking about this incredible movement into cash and money markets and really what the price of it's been, and look at the performance of looking at having actively managed investment portfolios versus just being in cash. And while we think it's been an emotional decision, it hasn't really been a decision that's really paying off in investment terms. So if you want safety and income, there's a lot can be found in fixed income, and we think that makes an awful lot of sense. On the equity side, that we think we have full valuations in equity markets. In U.S. particular, so at 18.5, 19 times earnings. I don't think anybody would argue that's inexpensive. Canada is kind of in a similar boat. But I think what we have to do is we start looking as an investor. We have to be, one, underweight. This is a good time to be cautious. We haven't really touched on the debt crisis right now, but we have very low volatility. We should see more volatility moving into the debt crisis. And we think even when you get to the other side of it, depending on what that outcome is, we're going to see more volatility as we go through time. So on the equity side, either A, making sure we're buying good companies with good value, but also you don't need to be long only when you're buying equities.
That's true.
Right?
That's true. There's different ways to play a market.
Right. So you can hedge, you can run long, short, and market neutral strategies, and this is an environment really made for that. The long, short, and market neutral strategies have a cash position, which pay a cash return in it, and then you have your equity return that you make on top of that. And so we think that in this situation makes a lot of sense too. But for real clarity in this is that this is a time where you're going to be allocating during periods of volatility. It's a difficult thing to do.
Patience and perseverance. Right? You make your choice and then
that's it.
See it through.
And so I think that like for us, that's really where when we look at it is in our quarterly strategy we published this month we called it the kite, and that was about your investment portfolio was a little bit about moving in these shifting winds that are out there, but if you have a well-structured kite. And it's built to withstand and work within that environment, you can actually have a pretty good return with it. But you just got to make sure that it's structured in that way. And I think is probably the real key from here. It's about investment again.
Investment again. Patience, the word I've heard from several people lately, it seems to be the key.
Yes. Yeah, well, and well, patience is and having.
I'm terrible with patience myself, but that's why I'm trying to find some ground.
Yeah, well, that's right. I think the key is in one of the things I think for the last 10 years, making money was easy. The next 10 years, It's going to be about making money, but it's making money with investment acumen once again.
Always a pleasure, Brad. Always great to have you. Look forward to the next time.
Thank you.